Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabor, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, first quarter was pretty volatile, but second quarter we saw very strong gains in the equity markets. The S&P was up over 15%. This is the best quarter since 2020. We saw broad-based gains. The NASDAQ 100 was up 27%. We saw small caps do exceptionally well. They were up 20% as the Russell 2000 rallied. And then we saw international markets really influenced by the EM markets. And again, technology impacted markets saw gains over 20%. Fixed income was we saw steady gains, but nothing of note. I really want to dig into these equity markets and what were some of those drivers?
Great question, Brian, and thank you all for joining us today. So as Brian mentioned, it was an exceptional quarter for global equity markets. When you're seeing returns north of 20% in a quarter, that's a good year. But we saw that in a single quarter. So just really strong and broad-based strength. And to Brian's question, what drove it? And the answer is going to be something that's not as apparent from the headlines, but that is very influential and consequential. And the most important factor, in our opinion, has been the strength of corporate earnings. Corporate earnings have seen exceptional growth consistently in recent quarters, and that's expected to continue. In the second quarter, the S&P 500 companies are collectively expected to grow earnings about 23% relative to the same period a year ago. That is very strong growth, and it would mark the second consecutive quarter of 20% plus earnings growth for the S&P. Those are not typical numbers, but they're very important because when Brian spoke about these strong gains in equity markets, sometimes investors grow concerned that there's a lot of hype, there's bubbles forming and those types of things. But in this case, the earnings have been there to back up the gains so far this year, which has been a very important development. And the other point I'd note is that while Brian mentioned the technology sector has definitely led this earnings growth, it certainly has not been only technology stocks that are seeing strong earnings. It's actually been fairly broad-based across sectors and across the globe. So a really strong story in corporate earnings. The second point that we believe is important also relates to fundamentals, and it's around the resilience of economic growth. While there's a lot of headlines that suggest there's pervasive pessimism about the economy in the U.S. and overseas, there's concerns about the job market and the impact of AI that it may have in displacement of jobs, the reality is that the economy and job market remain stable and steady. Resilience is the term we've used time and time again in recent years. So the U.S. economy is expected to grow at about a 2% annual rate in the second quarter. That's a solid rate of growth and pretty consistent with what we would expect. On top of that, the job market remains stable. The unemployment rate is about 4.3%, which is historically a pretty low level. Jobless claims remain very low and muted. And when we look at the full picture, despite the headlines and the negative sentiment around the impact of AI on jobs, announcement from big corporations about layoffs, the job market in aggregate is still being characterized in this low hire, low fire mode that has led to a low unemployment rate and a steady job market. So overall, the economic picture is pretty stable, which has also been a supporting factor for global equity markets. The last factor I would note is there was a sharp shift in investor optimism from the first to the second quarter. In the first quarter, investors were growing increasingly concerned from the Iran conflict, the unexpected impact of that conflict, and how it would spread from energy prices to the broader economy to broader geopolitical conflicts elsewhere. And so while there's been more clarity on that of late, what happened in the second quarter is investors went to being preoccupied with the impact of the Iran conflict on markets to looking beyond and past it with the assumption that things would settle down soon and to begin thinking about all the opportunities in markets. And that speaks to the earnings growth that I talked about. It also speaks to some very noteworthy IPOs that came to market in the second quarter. SpaceX being the biggest IPO in history. Company went public this quarter, and it really was a bellwether event for markets given the size of that IPO. We also had announcements from Anthropic and OpenAI that they would be going public later this year. And so this is an unusual set of circumstances where you have companies valued close to or in excess of $1 trillion of market cap going public for the first time. Historically, they would have gone public much earlier, but they've been able to grow this value in the private market. So very noteworthy events for public markets because the everyday investor is now able to access some of these companies or will soon be able to do so.
Pete, thank you for those insights. I want to talk about market leadership. Was there any change in the second quarter?
Absolutely. There was a pretty sharp and notable change, and it may not have been perfectly captured in the headlines, but it was a very important shift that happened within stock markets amid these strong gains. So for much of the last decade, we've talked about the dominance of the Magnificent Seven stocks. These are the large technology companies that have benefited from these monopoly-like network effects. Companies like Amazon, Apple, Meta, Microsoft. And these companies generated exceptional growth in cash and cash flow. They had very capital-light business models that they were able to monetize time and time again through recurring revenue, and just were absolutely dominant businesses. And these stocks have grown into multi-trillion-dollar market cap companies and have been a big driver of stock market indices for over 10 years now. But what we've seen this year, so far in 2026, is a subtle but very important shift. So the Magnificent Seven stocks as a group are actually underperforming the market this year. So for the first half of the year, those stocks are down while the S&P 500 is up double digits. So the S&P 500 is up double digits despite the Magnificent Seven, some of the biggest stocks that are represented in the index, being down. And so why are these stocks struggling all of a sudden? Doesn't mean they're selling off massively, but they're just not leading the market anymore. And so what we believe the most important factor driving that is this transition from the capital light, cash flow rich business model that I spoke about a few moments ago to a much more capital intensive business model where they're building out the data centers that they expect to be the necessary infrastructure for the AI boom that is beginning and accelerating. So all of a sudden, they're not generating the same level of free cash flow and distributing it to investors. They're reinvesting that cash flow to make investments in building these data centers out. And they haven't yet fully figured out the business model for monetizing those investments. So there's a lot of questions around what will the ultimate return on investment when they are spending hundreds of billions of dollars individually and over $1 trillion collectively on these capital expenditures. So it's been a shift in their business model, and the stock market seems to be picking up on that in what it's pricing in terms of stock prices that are rising and lagging. The flip side of that is where we've seen the most strength in the equity market is the companies that are benefiting from all of the spending from the Mag 7 companies. And so these are AI infrastructure stocks, most notably the semiconductor stocks, which have historically been cyclical and more commoditized technology industries that have not kept pace with the Mag 7 and software type of businesses. They are the ones that are shining at the moment, and they are seeing exceptional gains. So for example, the iShares Semiconductor ETF was up over 100% in the first half of the year. That's where you're getting exposure to companies like Micron Technology, Advanced Micro Devices, Intel, and these companies that have historically been lower margin, more cyclical businesses, all of a sudden have seen this massive exponential increase in demand. And because of that, they're seeing very strong gains in their stock prices. And we're seeing it in other areas within technology. Memory chips, something that's been around a long time, all of a sudden they're in shortage because of demand from the AI build out. And you're seeing companies like SanDisk, you're seeing companies like Samsung and SK Hynix in South Korea that are these tech hardware companies that all of a sudden are seeing massive growth and massive gains because of the AI build out. So the beneficiaries of the spending from the Mag 7 are really what has been driving markets, which has been this big shift in leadership over the past quarter.
Hey, thank you for those perspectives. What are the key questions for the second half of 2026?
Yeah, the biggest question from my perspective is, have the stock markets risen too far too fast? And so Brian and I both spoke about earlier the historic level of gains in markets in the second quarter. There's also been increasing recognition among market participants in the financial media that there's some parallels to this period, to the late 1990s, when we saw a lot of technology companies really see exceptional gains in stock prices in a short period of time. The IPO market opened up and a lot of companies were listing publicly, and there eventually was a bubble that formed that crashed. And from our vantage point, while there's some parallels, the circumstances and environment today is different. The most notable is the fundamentals. So the big technology companies that I spoke about earlier, both the Magnificent Seven and the semiconductor stocks and the memory stocks that I spoke about as well, they are highly cash generative businesses with proven business models, strong margins, and there's been exceptional growth in demand for their products and services. So that's a different backdrop than much of the late 1990s, where you had a lot of startup companies that many didn't have profits or cash flow, much less revenue, and it was just a different environment with lots and lots of companies going public. We're not seeing that today. The companies that are going public today are well-established leaders in their industry, SpaceX being an example, Anthropic and OpenAI being other examples. And they have established businesses. Some of them are profitable. All of them are generating meaningful revenue, but all have a path to profitability and a sustainable one. And they're very dominant companies and businesses. So just a very different dynamic. But that said, investor optimism has grown. And when investor optimism grows, there's less margin for error. And so investors just need to be aware of remaining prudent and understanding the risks alongside the opportunity and not getting swept up in the euphoria of these strong gains in AI technology stocks. The second point gets back to the economy, and it's something that's usually talked about and is front and center, but in the second quarter really took a back seat, and that's inflation and interest rates. So inflation we've been talking about for years now, but it does remain elevated. It has risen since the Iran conflict, so it's well above the Federal Reserve's 2% target. So the Consumer Price Index in May rose over 4% year over year, so it's double the Fed's target. And so there is a path, an expected path for inflation to cool, especially as energy prices normalize since the conflict is settling down and the like, but it's not going to happen overnight. And some of the follow-on effects from the sharp spike in energy prices higher is filtering through the economy, and it'll likely continue to do so over the rest of this year. So elevated inflation is likely going to remain with us for some time. And the reason that matters is that it impacts interest rates. And so interest rates weren't talked about a whole lot during the second quarter because the stock markets were so strong. But what we saw was shorter term interest rates, so as measured by the 2-year U.S. Treasury yield, actually rose a decent amount during the quarter. They're now above 4% at this point, which is a much higher level than they were just a year ago. And that's basically pricing expectations that the Federal Reserve is more likely than not going to raise interest rates or not cut interest rates as much as the market was expecting. So that means a more hawkish Federal Reserve. And if that does play out that way, that can take some of the fuel out of markets and can dampen some of these optimistic vibes that I was talking about earlier. So that's also something we'll be watching. We have a new Fed chair in Kevin Warsh. He's came out in his first news conference and said his number one priority is price stability, which is no surprise. That is what the primary mandate of the Fed is. But he also talked about fresh thinking in a new chapter at the Fed, which means change is afoot and change is likely to come sooner than later. So that's something else that markets are going to need to digest and react to with a new chair with a new agenda in place at the Fed.
Pete, thank you for those insights. Is there anything you'd like to leave investors with as far as how to navigate the current environment?
Yeah, 3 things I'd like to leave you with. The first is to maintain discipline. When we see stock market gains like Brian spoke about at the outset of this conversation, it's hard to say, man, I want to participate fully here, but I haven't, so I need to take more risk. I need to change my portfolio. I need to get in on the action. I need to get in on the IPO on day one. And that behavior historically has not served investors well. Fear of missing out, chasing whatever's doing well recently is not a long-term investment strategy. Doesn't mean that you don't have exposure to and participate in those things, but stay disciplined to your long-term investment plan. Don't rewrite your strategy because of a short-term period of exceptional performance in certain areas of the market, and stay on track and focused on what the long-term goal is, not necessarily trying to beat the market on a quarter-to-quarter basis. So that's the first point, is to maintain discipline. The second is to stay diversified. So Brian spoke about it at the outset. The equity markets had tremendous gains in the second quarter, but bond markets, they rose a little bit, but there was nothing really of note in the bond market world. Well, bonds are there as a diversifier in most portfolios. And so just because bonds haven't performed well of late doesn't mean that you should just naturally load up on equities or stocks and forget the bond side of the ledger. They're there to align your portfolio to a certain level of risk. And so times like this, it's important to do things like rebalance to make sure your portfolio stays aligned to its risk target, not to get swept up in the moment and get overly concentrated in a certain part of the market or out over your skis in terms of your risk level that could lead to some damaging consequences down the road. And then third, and most importantly, is you don't need to be on this journey alone. Engage with your financial advisor and make your plan a living plan.
Pete, thank you for all those perspectives. Thank you for joining us today. We hope you have a wonderful summer, and we look forward to updating you on financial markets in the coming fall.
Thank you.